Hello, this is the ChartProfit video. Over 2 hours into the trading day on Friday the 5th of February. It's been another frustrating week for the market. We're looking here at the pre-open, at the profiles for the E-mini S&P. We've had a succession of value areas here above the important level, which is 1870. And in fact, this week, as you know, we probed very briefly below that level, and that was rejected, which is usually a positive sign. So really want the E-mini to hold above this 1870 level, or if tested like here, to be quickly rejected. I was actually hoping for a strong close at the end of this week. It would have looked like a higher low on that level, which would have been quite encouraging. And currently, if I look at the live chart here, this is a daily chart but it's live, you can see that the E-mini at 1875, not far above that important level again. So I'm just hoping for support here. Do not want to see price printing time below that level. Puts the market in a really weak price location. If you look here at the spider on this live chart here, from the low, this year's low here, to the high, you can see the halfway point is very close to the point of control, 187.20 here. On the stock index ETFs, like the spider, we've seen the momentum of the price oscillator, although it's been negative, it is heading higher. So again, that's mildly encouraging. I'm looking at the pulse chart here, you can see the low of the week so far. Hopefully Friday won't close below it, but we did hold that time support. There's the price oscillator heading higher. The breadth has gone to neutral from negative. But you can see we still need to see some improvement here, so some green coming in at this point on the breadth, this getting back above zero, and the spider holding this level. That's what I'm looking for early next week. Break below this point, and any best case scenario that are outlined in the pre-open would be negated. Here's the breadth chart through yesterday, which gives us that neutral on the pulse chart, because the bullish percentage of stocks greater than the 50-day moving average still below 30 here, but this indicator, just this one here, just above zero, and that's the 5-day moving average of the net new highs 25 indicator. So this one's just sneaked above its level, this one way from it. A lot of work to do before this moves into a more bullish mode. We're oversold on the sentiment indicators, if that's the right word. There's plenty of bears out there. This is the Ridex, which we follow each day. My version of the ratio down just above 4, but it's been down to 3.5 at this point here, relative to where it was above 9 late last year and early last year. That's really low. Since early December, there's been a climb in the bear fund assets that I follow, and a very low level of assets in the bull funds. Down here at levels that usually, certainly over the last few years, has marked the bottom of these corrections. One of the sentiment indicators that we follow is the data from Lipper US fund flows. I follow it week to week on the histogram here, the red bars at the back, noting that Lipper reported equity funds, including ETF, outflows this week of 6.5 billion, which brings us here, and we follow a cumulative 4 weeks. We call it the 4-week flow, and that's the black line at the bottom here. Not as low as it has been, but again relatively low. But I can watch that flow over as many weeks as I want. I've got here an 8-week flow, so the net flow over the last 8 weeks, and that is extremely low. If we look at the opinion polls, this is the public poll from AAII. Bulls percent was lower this week at 27.5. 3 weeks ago, the Bulls percent at 17.9% was the lowest since April 2005. Bears percent was lower at 34.7, and 2 weeks ago that reached 48.7. That was the highest since April 2013. So over the last couple of weeks there's been an increase in optimism, but from a very pessimistic level. I'm also saying here that we should note that the 4-week moving average of the net, that's the Bulls minus the Bears, that's the black line here, which is at 18.05, and that's up from a negative 20.28 the previous week, which was the lowest reading since 2009. These are quite extreme levels of bearish sentiment, and certainly since the bull market started in 2009, these kind of levels would be a point where we would start to anticipate a market bottom. If we do not see the market bounce, then we can start thinking that maybe we're in a different kind of market, possibly a bear market here. Also note in the investors' intelligence poll, the newsletter writers, if we look at the bulls minus the bears and the 4-week moving average of that net, that's the black line here, that's down at minus 6.7, and that is a 4-year low. Exposure index, that's the active money managers' current equity exposure. That fell quite sharply this week. It's now down at 22.41. Here, that's the lowest since October. Anything below 30, and again, looking back over a few years, this is the level where the market usually makes its low. I hate to use the word hope, but what I'm looking for is a higher low, and back on the spider chart here, above this level. Considering the bearish sentiment that we just looked at, that would be reasonable, but as I just mentioned and reiterate, price under here puts the market in a dangerous position. Just look here at the European markets, the DAX, the 93.07 major point of control, which has been supporting, and this level goes back a long way, and we are actually below that point at the end of this week here. So again, looking for a bounce at these points. And price under here early next week, would want to see it quickly snap back. And the UK FTSE 100, again, looks like we're finishing the week here below its major point of control. And again, going into next week, price down here, really want to see it snap back. This is weak price location here. Looking here at bonds, this is IEF, the 7 to 10 year ETF. At this level down here at 105, the major point of control marked for many months. Late last year, we made that low. There was a consolidation and we broke above the 18-month point of control. And at this point here, we broke above the half range off last year's high. And bonds have been really strong here. This is USO, the oil fund ETF. Made its low here last month. I'm now monitoring this half range from that point, hoping that USO can hold that level. And here on the futures, this is GLD, the gold ETF. Been a really strong rally in gold this year. The major levels are still a little higher before we can look at a long-term change of trend. I note we're getting overbought here on the oscillators. This is a 14-day RSI above here, and you can see at these points, and we're back there now above 70, which is the typical kind of an oversold level, beg your pardon, overbought level. Not very well drawn, but you can see usually correspond to lower highs on the chart for the last couple of years. I've been saying the last couple of weeks that the dollar, I was expecting that the dollar would hold at the higher level. We were looking for the point of control to migrate higher, and I was looking for the dollar index to hold this level off the recent probe above the March high, but it certainly didn't do that, and this week it has fallen really sharply to a new low for the year. Large component of the dollar index is the Euro FX chart. The chart's been really strong this week. We've seen a spike higher, actually above the minor or more minor half range here, which is the half range off last year's low. And the major resistance on this chart is at 112.41. We've had these levels marked for many months, and this is a really important level. It seems to have capped the rally this week. Price above that level would put this chart actually in a strong price location. Hasn't managed to do that yet. Almost didn't show this chart, but I know some of you enjoy the time cycles. This, for sake of completion, is the average February for the Dow in a 6-year in the decennial cycle, and it tends to rally through to about the 21st, and then it gives it all back. Right now with the market the way it is, I'm not sure how much I'm going to rely on decennial patterns. Which is the final chart. We go back to this. I'd rather rely on this level here on the S&P and hold. We hope that, hope for some green here and for the price momentum to pick up. That's the hope, but I think I've used the word hope too many times in this webcast. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.